$38 trillion. America's national debt just hit a number so large it has lost all meaning. But here is what that number actually means. Every single American now owes $112,000. Every household owes $300,000. And the interest payments on that debt just exceeded what America spends on defense. $1 trillion per year, just to pay interest. Not to build roads, not to fund schools. Just interest on money we already borrowed. And here is the part nobody is talking about. The debt is accelerating. It took America 232 years to reach the first trillion. From George Washington to Ronald Reagan, 1 trillion in 232 years. But it took just 8 months to add the last trillion. 8 months. We are now adding $1 trillion in debt faster than it takes to have a baby. And the acceleration is not slowing down. It is speeding up. But the truly terrifying part is not the size of the debt. It is what happens when we cannot afford the interest. Because that moment is coming. Not in 20 years. Not in 10 years. Within the next presidential term. The Congressional Budget Office projects that by 2030, interest payments will consume 20% of all federal revenue. 20%. Just for interest. And when interest payments exceed what you can afford, you have 3 options. Cut spending, raise taxes, or default. And all 3 options destroy the economy. The debt crisis is not a future problem. It is a math problem. And the math has already failed. Before we show you exactly how bad the numbers are, and what happens when this debt bomb detonates, hit that subscribe button and join the Wealth Forum. We expose the financial disasters before they destroy your savings and show you how to protect everything you have worked for. Turn on notifications. What comes next will change how you see America's future forever. Now let's talk about how we got here and why this is different from every other time America had high debt. Let's go back to World War II. America's debt hit 106% of GDP in 1946, the highest in American history. But here is what happened next. America grew its way out. The post-war economic boom lasted 30 years. GDP grew 4% per year. Manufacturing exploded. The middle class expanded. And the debt to GDP ratio fell to 23% by 1974. America did not pay off the debt. It grew the economy faster than the debt grew. And the problem solved itself. But that was then. This is now. And the conditions that allowed America to grow out of debt no longer exist. In 1946, America was the only industrial power with intact infrastructure. Europe was destroyed. Japan was devastated. China was in civil war. America had no competition. Today, America competes with China, Europe, and emerging markets everywhere. The monopoly is gone. In 1946, America was a creditor nation. We lent money to the world. Today, America is a debtor nation. We borrow from the world. In 1946, Social Security and Medicare did not exist. Today, they consume 40% of the federal budget. And they are growing. In 1946, the population was young. Today, 10,000 baby boomers retire every day, and they will for the next 15 years. The demographics have reversed. Here is the simple truth. In 1946, America could grow its way out of debt because the economy was expanding faster than obligations. Today, obligations are growing faster than the economy. Social Security costs increase every year. Medicare costs increase every year. Defense spending increases every year. And tax revenue is not keeping pace. The gap between what the government spends and what it collects is over $2 trillion per year. $2 trillion every single year, and that gap is widening. Think of it like this. You make $100,000 per year, but you spend $130,000. You borrow $30,000 annually to cover the difference. At first it works. You can afford the interest. But after 10 years, you owe $300,000. The interest alone is $15,000 per year, then $20,000, then $30,000. At some point, your entire salary goes to interest, and you cannot borrow anymore. That is where America is heading, and we are closer than most people realize. Here is the number that should terrify you. In 2020, America paid $345 billion in interest on the debt. In 2025, it is over $1 trillion. In 5 years, interest payments tripled, and they are still rising, because the Federal Reserve raised rates from near 0 to 5%. Every dollar of debt now costs 5% per year, and America has $38 trillion in debt. That is $1.9 trillion in annual interest, if all debt were at current rates. But here is the problem. Not all debt is at current rates yet. As old bonds mature and new bonds are issued at 5%, the total interest burden will keep climbing to $2 trillion, then $2.5 trillion, until it consumes everything. Now let's talk about the mechanics. How does a debt crisis actually unfold? What are the stages? And what triggers the breaking point? Stage 1 is the interest rate trap. This is where America is right now. The Federal Reserve raised rates to fight inflation, from near 0 to 5%, and that made borrowing expensive. But here is the catch. The federal government borrows $2 trillion per year just to cover the deficit. It has no choice. So when rates go up, the cost of borrowing goes up, and the deficit gets worse. Higher rates mean higher interest payments. Higher interest payments mean bigger deficits. Bigger deficits mean more borrowing. And more borrowing means even higher interest costs. It is a feedback loop, and it is already in motion. Here is a real example. In 2024, the Treasury issued $1 trillion in new bonds at 5% interest. That is $50 billion in annual interest. Forever. Just for $1 trillion. And America issues new debt every single quarter. Every auction locks in high interest rates. Every auction makes the problem worse. And there is no way out without raising taxes or cutting spending. But raising taxes slows the economy. And cutting spending is political suicide. Stage 2 is the bond market rebellion. This is when investors lose confidence in America's ability to repay. Right now, the US Treasury is considered the safest asset on earth. Investors buy Treasury bonds because they trust America will always pay, but trust is not infinite, and it is not guaranteed. If investors believe America's debt is unsustainable, they will demand higher interest rates to compensate for risk. Not because the Fed raised rates, but because they do not trust the government to pay back $38 trillion. Here is what that looks like. Imagine the Treasury tries to auction $100 billion in bonds, but investors only bid $80 billion. The auction fails. To attract buyers, the Treasury has to offer higher yields, much higher, maybe 6%, then 7%, then 8%. And when yields spike, the interest burden explodes. An 8% interest rate on $38 trillion is $3 trillion per year. That is more than the entire defense budget, Medicare, and Social Security combined. The government cannot function, and the system breaks. Stage 3 is the fiscal crisis. This is when the government cannot pay its bills, not because it chose not to, but because the math does not work. Tax revenue is $5 trillion per year. Interest payments are $1 trillion and rising. Social Security is $1.3 trillion. Medicare is $1 trillion. Defense is $850 billion. That is $415 trillion right there. And we have not funded anything else. No education, no infrastructure, no veterans benefits, no federal employees. The money runs out, and the government has to choose, pay interest or pay Social Security, pay bondholders or pay the military. Every choice is catastrophic. Stage 4 is the political crisis, because when the government cannot pay, someone does not get paid. If Social Security checks stop, 70 million retirees lose income. If Medicare payments stop, hospitals close. If defense contractors do not get paid, weapons production halts. And if bondholders do not get paid, the bond market collapses and takes the global financial system with it. There is no good option. Every choice creates a crisis, and every crisis creates political chaos. Stage 5 is the currency crisis. This is the breaking point, when the government cannot pay its bills and cannot borrow anymore. It has one option left: print money. The Federal Reserve buys Treasury bonds directly. It creates dollars out of nothing. And those dollars flood the economy. At first it works. The government can pay its bills. But then inflation returns. Not 4%, not 6%, but 10, 15, 20%. Prices skyrocket. Wages fall behind. And the dollar loses value, internationally and domestically. Countries that hold dollars dump them. The global reserve currency status ends. And America's exorbitant privilege disappears. This is the mechanics of a debt crisis. It does not happen overnight. It unfolds in stages: interest rate trap, bond market rebellion, fiscal crisis, political crisis, currency crisis. Right now, America is in stage 1, moving toward 2. And once stage 2 begins, stages 3, 4, and 5 follow fast. The question is not if, the question is when. Now let's talk about the crisis, the exact moment when this breaks, and what that moment looks like when it arrives. Here is the breaking point. And it is closer than anyone wants to admit. The trigger will be one of 3 events: a failed Treasury auction, a credit rating downgrade, or a Social Security funding crisis. Any one of these can light the fuse. Trigger 1 is a failed Treasury auction. The US Treasury auctions trillions in bonds every year to fund the deficit. And for decades, those auctions have been oversubscribed. More buyers than bonds, But what happens when there are not enough buyers? What happens when China does not buy? When Japan does not buy? When Europe does not buy? The auction fails. And when a treasury auction fails, the entire financial system panics. Because if America cannot borrow, America cannot pay. And if America cannot pay, everything collapses. Here is why this is possible. China has been selling US treasuries for 3 years straight. Their holdings dropped from $1.3 trillion to under $800 billion. Japan is the same, selling to defend the yen. Europe is drowning in its own debt and cannot buy American debt. And domestic buyers are stretched. Banks, pension funds, and insurance companies already hold trillions in treasuries. They cannot absorb unlimited supply. At some point, demand runs out. And when demand runs out, yields spike. And when yields spike, the interest burden becomes unsustainable. Trigger 2 is a credit rating downgrade. The United States has an A credit rating, the highest rating. It means America's debt is risk-free. But in 2011, S&P downgraded the US to AA+ for the first time in history. The stock market crashed 17% in 4 days. And that was when the debt was $14 trillion. It is now $38 trillion. If S&P downgrades again, or if Moody's or Fitch downgrade, the panic will be worse. Because a downgrade tells the world that America's debt is no longer safe. And if America's debt is not safe, nothing is safe. And here is the dangerous part. Credit rating agencies are backward-looking. They do not downgrade until the crisis is obvious. By the time they downgrade, the damage is already done. Markets have already priced in the risk, and the downgrade accelerates the collapse. It is a lagging indicator, but it creates a leading catastrophe. Trigger 3 is the Social Security funding crisis. Social Security is funded by payroll taxes. Workers pay in, retirees take out. But since 2021, Social Security has been paying out more than it takes in. The deficit is being covered by the Social Security Trust Fund, A's $2.8 trillion reserve, built up over decades. But the Congressional Budget Office projects the trust fund will be depleted by 2033, 8 years. When the trust fund runs out, Social Security benefits must be cut by 23%, automatically, by law. Imagine you are 68 years old. You receive $2,000 per month in Social Security. That is your only income. And one day, your check is $1,540, a 23% cut. Overnight, you cannot afford rent. You cannot afford food. You cannot afford medicine. And there are 70 million people in this situation. 70 million. The political pressure to fix this will be overwhelming. And the only way to fix it is to borrow more, or print more, or raise taxes massively, all of which make the debt crisis worse. Here is the doom loop. A failed auction raises yields. Higher yields increase interest costs. Higher interest costs increase deficits. Larger deficits require more borrowing. More borrowing triggers credit downgrades. Downgrades trigger more failed auctions. And the cycle accelerates until the system breaks. Each event triggers the next. And the speed is exponential, not linear. And here is what makes this different from past crises. In past crises, America could borrow its way out. In 2008, the government borrowed to bail out banks. In 2020, the government borrowed to fight COVID. But both times, interest rates were near zero. Borrowing was cheap. Today, rates are 5%. Borrowing is expensive. And the debt is already $38 trillion. There is no room left. The ability to borrow your way out of a crisis requires fiscal space. And America has none. The breaking point is not theoretical. It is mathematical. And the math says we are out of time. Now let's talk about the consequences. What happens when America's debt crisis goes critical? And what you need to do right now to survive. Here is what happens when America's debt crisis breaks. And here is what you do to protect yourself. Consequence 1 is inflation returns. If the government prints money to pay its debts, inflation spikes. The 2022 inflation crisis will look mild compared to what comes next. We are talking double digits. Groceries that cost $100 today will cost $150, then $200. Your savings lose half their value in years. Here is what you do. Move 20 to 30% of your wealth into inflation-resistant assets. Gold, silver, Bitcoin, real estate, commodities, assets that hold value, when dollars do not. Consequence 2 is interest rates spike. If bond auctions fail and investors lose confidence, yields will soar. Mortgages will hit 10%, car loans 12%, credit cards 30%. Borrowing will become impossible for ordinary people. Here is what you do. Lock in fixed rate debt now. If you have a mortgage at 6%, keep it. If you need a car, finance it now before rates go higher. And eliminate all variable rate debt. Credit cards, HELOCs, anything with a floating rate. Pay it off or refinance to fixed. Consequence 3 is the dollar loses reserve status. If America cannot manage its debt, the world will lose confidence in the dollar. Countries will trade in yuan, in euros, in gold, and the dollar's 80-year reign as global reserve currency will end. This means America can no longer export inflation. It comes home, and when it comes home, prices explode. Here is what you do. Diversify out of dollar-only assets. Hold some wealth in foreign currencies, Swiss francs, Singapore dollars, Norwegian kroner. Not to speculate, to hedge. Consequence 4 is Social Security and Medicare cuts. If the government cannot borrow, it cannot fund entitlements. Benefits will be cut. Eligibility ages will rise, means testing will eliminate benefits for higher earners. If you are counting on Social Security to fund retirement, do not. Here is what you do. Build your own retirement. Max out retirement accounts. Invest in dividend-paying stocks. Rental real estate. Create income streams that do not depend on the government, because government promises are only as good as government solvency. Consequence 5 is stock market volatility. A debt crisis creates massive uncertainty. Stocks will swing wildly, crashes followed by rallies followed by crashes. This is not the time to panic sell, but it is also not the time to be all in on equities. Here is what you do. Reduce exposure to growth stocks. Tech stocks trading at 40 times earnings. Speculative plays. Move into defensive stocks. Utilities. Consumer staples. Healthcare. Companies that provide essential goods and services, and keep 20 to 30% in cash or cash equivalents. When the crash comes, you will be ready to buy. Here is your action plan. First, eliminate high-interest debt. Credit cards. Personal loans. Anything above 8%. Pay it off now. Second, build an emergency fund. 12 months of expenses, not 6. 12. Debt crises last longer than people expect. Third, diversify your assets. Do not keep everything in dollars. Do not keep everything in stocks. Spread your wealth across asset classes and currencies. Fourth, invest in skills. If the economy contracts and unemployment rises, skills matter. Learn something valuable, something that generates income in any environment. Fifth, prepare mentally. A debt crisis is not a one-day event. It is a multi-year grind. Fortunes will be made and lost. The people who thrive are those who stay disciplined, who do not panic, who buy when others sell. The debt crisis is not coming. The debt crisis is here. The only question is whether you are ready. So here is the lesson. America's debt problem is not a political issue. It is a math issue, and the math has already failed. 38 trillion in debt, $1 trillion per year in interest. Deficits growing every year. Demographics working against us, and no political will to fix it. The breaking point is not decades away. It is years away, maybe less. History teaches us that all empires face the same choice: adapt or collapse. Rome chose collapse. Spain chose collapse. Britain chose decline. And all of them face the same problem America faces now: unsustainable debt, overextended obligations, and the refusal to make hard choices until it was too late. The unsettling truth is this: America will not default in the traditional sense. It will not say we are not paying. It will inflate the debt away, print dollars, devalue the currency, and destroy savers in the process. This is how every debtor nation in history has solved its debt problem. Not through discipline, through debasement, and the people who suffer most are those who trusted the system, who saved in dollars, who believed the government would protect their wealth. So here is what you do. If this video made you realize America's debt problem is worse than you thought, and you need to protect yourself now, smash that like button. Subscribe to the Wealth Forum, turn on notifications, share this with anyone who still thinks the debt does not matter.